Hey, this is Chris, and in this video, I'm going to be talking about why the market is going to fall 10% and what you can do about it. Now, if anyone has seen my videos before, one thing you'll know for sure is I hate making predictions, and I don't think anyone can accurately make short-term market predictions. There are a lot of strategists out there that like to predict where the market will be in 6 months or a year's time, but inevitably these predictions are hopeless and no one knows what's happening in the short term. So you might wonder why I'm predicting the market will fall 10%. And the answer is that almost every year in history, at some point, the market falls 10%. In fact, over all of time, there has only been 5 years where the market hasn't fallen at least 5% during the year, and only a few more where the market hasn't fallen 10% at some point. In fact, the average fall from peak to trough within a year on the share market is around 14%, which means when you invest into shares, you should expect at some point during the year, the market will be down 14% from your high point. Now, if you're diversified, of course, across other asset classes like bonds and gold, that will be cushioned a little, and so you probably won't see a 14% fall every year, but you might see half of this, or you might see a quarter of this. Inevitably, markets go up and down. When you invest, that's actually why you earn a better return than leaving your money in the bank, because you're accepting the inevitability of these ups and downs during the year in order to earn the great long-term returns of the market. And so my prediction is just that every year you should expect that there's going to be a 10% fall at some point. Now, at that point, what you know for sure is that there are going to be TV headlines that the Dow Jones has fallen X thousand points, or the ASX has lost $60 billion. This should be music to your ears, and you shouldn't be one of the people that freaks out when they see these headlines. Freaking out when you see headlines like this would be like seeing that there's a sale in your favorite shop and saying, that's it, I'm not going to that shop this week. I'm staying well away from that shop because there's a 10% off sale. And that's crazy, of course. And in the same way, avoiding share market sales is a crazy thing to do. And so my 3 tips when there are these inevitable 10% dips in the market each year are, first of all, stay calm. Try and block out the noise, block out what others were saying about what you should be doing. There are going to be a lot of people that tell you that it's time to sell or it's time to get out and wait for things to calm down. What we know from almost every year is that when everyone is trying to get out and wait for things to get better, that is the time that you shouldn't be getting out because it's already in the price. All of the fear is already in the price and there's no point exiting at that point. The second tip I have is use these dips as an opportunity to buy. Just as when you see a sale at your favorite shop, it's a great time to go and buy those things you've been waiting for. A share market sale is the great time to be getting in there and topping up your portfolio, because this is what's going to give you an edge over the long run and give you some extra returns. Being able to get in there and buy when everyone else is fearful is going to help boost your returns in the long run. And my final tip is let StockSpot rebalance your portfolio when these market dislocations happen. So 2020 was a great example when markets had a huge fall of 30%. That is actually a wonderful opportunity to be selling low risk assets like government bonds or selling term deposits or getting rid of cash in the bank and using or deploying that money into risky assets like shares. And if you can follow these tips, what you're going to be able to do is always use these 10% dips every year as a great chance to boost your long-term investing returns.